Three decisions, that's all any financial manager ever makes. Invest, finance, manage the day-to-day. Everything else, the reports, the budgets, the board meetings, is just a way of making those three decisions better. In the next 7 minutes, you're going to understand exactly what those decisions involve, why maximize shareholder wealth means something very precise, and how companies stop their own directors from quietly working against the people who own the business. Finance is the management of money. Investing it, borrowing it, lending it, budgeting it, forecasting it. That applies to individuals, governments, and companies. But for a company, there's one overriding objective driving all of it. Maximize shareholder wealth, not just profit, wealth. Specifically, that means maximizing market capitalization, share price multiplied by the number of shares in issue. Grow that number, that is the job. So how does a financial manager actually do it? 3 functions. Function 1, investing. Money goes out today, so more money comes back tomorrow. That could be buying machinery, funding R&D, acquiring a competitor, or even downsizing to cut costs. Every potential investment needs scrutiny. How big are the cash flows? When do they arrive? And how risky are they? Function 2, financing. Before you can invest a single pound, you need to find the money. It comes from 2 places, shareholders or lenders. The financial manager has to pick the right source for each investment, right timescale, right flexibility, and at a cost the business can actually afford. Function 3, managing daily financial activities. This is working capital, stock, debtors, cash, creditors. It sounds mundane, it is not. Run out of stock and you lose customers. Hold too much stock and you waste cash. Carry too many unpaid invoices and your cash flow dies, even if your profit looks healthy. There is a constant balancing act here, every single day. Here is something most introductory videos skip. Statement of financial position, non-current assets. Land, buildings, machinery, labeled investing. Share capital, retained earnings, debentures, labeled financing. Inventory, trade receivables, cash, trade payables, labeled daily activities. Every single line on a company's balance sheet traces back to one of those 3 functions. Non-current assets, the investments, share capital and debentures, the financing, inventory, receivables, payables, working capital. The financial manager's fingerprints are on every number. Now, who actually does all this in a real company? In a large business, you'd have a finance director at board level, a financial controller below them, and then a team of specialists, cash manager, credit manager, tax manager, capital expenditure accountant, different people. Same 3 functions divided between them. In a startup, it might be one person, the founder, doing all of it. The structure changes, the function doesn't. Maximizing shareholder wealth is a long-term goal. In the short term, financial managers set specific targets to get there. Grow earnings per share, cut borrowings, improve margins, increase efficiency. But companies also have non-financial objectives: becoming market leader, strong supplier relationships, environmental responsibility. And here's the tension. Those objectives can clash. Cut costs aggressively, and you might destroy staff morale. Push for rapid growth, and you might take on dangerous levels of debt. There's no single correct path to maximizing shareholder wealth. 2 financial managers with completely different strategies, one lean and cost-focused, one aggressive and growth-focused, can both get there. What matters is that everyone in the organization is pulling in the same direction. Here's the issue that doesn't get enough attention. In a large company, the shareholders own the business, but they don't run it. Directors do. This is called an agency relationship. The directors are supposed to act in shareholders' interests, but their actual priorities might be their own job security, their salaries, and not rocking the boat. A director might quietly avoid a risky but profitable project because they fear the fallout if it goes wrong. That's money taken from shareholders, even if no rule was broken. So how do shareholders fix this? 1. Remuneration packages. Pay directors in a way that rewards them when shareholders benefit. This means bonuses tied to earnings per share growth, not just salary. And share options. Here's how share options work. Say the current share price is 1.60. A share option grants the director the right to buy shares at 1.80 1 year from now. If the price climbs to 2.20, the director exercises the option, pays 1.80 and holds a share worth 2.20. That's a 40p gain per share on potentially hundreds of thousands of shares. The director is now very motivated to see the share price rise, exactly aligned with shareholders. One catch, share prices are also moved by things management can't control. Interest rates, inflation, government policy. So some companies link the exercise price to a market index, like the FTSE. That way, directors only benefit if the company outperforms the market, not just if a rising tide lifts everything. 2. Monitoring. Shareholders review annual financial statements, compare performance against competitors using ratio analysis, and track press coverage of the company. 3. AGMs. Shareholders can attend, question directors directly, and vote. And if they're still not happy, they sell. All of this needs a plan. A company sets a high-level corporate plan, vision, mission, direction. Under that sits the financial plan, which details how the 3 finance functions will actually deliver it. Expected sales, capital expenditure, cash flows, working capital requirements, staffing costs. But this plan doesn't get built in a vacuum. External constraints shape it. Government policy, interest rates, inflation, competitive pressure. The financial manager has to account for all of them. And the plan is a tool, not a trophy. Effort spent producing it must be weighed against the value of what it actually tells you. Three functions, one goal, an agency relationship that needs careful design, and a financial plan that connects the whole thing. This is the foundation every other module builds on. Next, Module 2 goes deep on where the money actually comes from, equity, debt, and everything in between. Subscribe so you don't miss it. 3 decisions, that's all any financial manager ever makes. Invest, finance, manage the day-to-day. How companies stop their own directors from quietly working against the people who own the business. In a startup, it might be one person, the founder, doing all of it. Shareholders review annual financial statements, compare performance against competitors using ratio analysis, and track press coverage of the company. AGMs. Shareholders can attend, question directors, and vote, and if they're still not happy, they sell.